Hi traders, Chris Weston here from Pepperstone, Head of Research. So what we'll do is go through the charts that matter today. We'll get you set up for the week. We're going to go through the traders environment. I think rather than necessarily just go through the data points, I think it's really good to see the sort of trading environment by which we're going to cut our craft across asset class for the coming weeks. So I thought I'd probably break this up into 4 segments. First of all, we're going to have a look at the platform that we've been set, effectively a review of what's happened and the stage that we've been given for the new trading week ahead and how we can attack that. Secondly, we're going to have a look at the landmines, i.e. the event risks that we really need to look at and navigate our portfolios through in the week ahead. We want to have a look then at some of the charts, some of the sort of top-down, high-level sort of charts that we've been looking at and ultimately where the probabilities lie for the week ahead. And then I'll go through a few charts that I think are really important as well for broad asset volatility. So hopefully this gives us a broad understanding of how financial markets are set and helps us attack the new trading week ahead. But before we do that, let's have a quick look at the disclaimer for compliance purposes. Okay, so with that out of the way, let's go into the platform and have a look at the markets and how they've been set up, because whilst we look forward as traders, I think it's really important to understand the sort of stage we've been set, because we do take a lot of that sentiment in. Okay, so let's have a look at I'm going to look at use a mixture of Bloomberg charts and also trading view charts and also some Excel stuff which have been pulled out, so it gives you a sort of broad oversight. But the first one here, let's have a look at the equity market moves just to see where the capital has been flowing. Obviously past performance doesn't necessarily mean future returns, but what it does do is it shows us where the momentum has been. And I think we can use that very simplistically to say, well, things that have been strong generally stay strong, or at least will be well supported on pullbacks. And we'll look at the technicals in a second. So what we've been saying, if we have a look at the last 5 days, you can see that the S&P was up 1.2% in dollar terms, and you can see how this is on a constant currency basis against US dollars here. So this is the column we're looking at. We're just seeing the outperformance of markets in that situation. So you can see here that the MIB in Italy was pretty strong, one of the best performing markets. You can see that we saw some really strong gains last week coming through in the Nikkei, also in the CSI 300. So China, Japan really outperforming, and we also saw the S&P having a strong game of European markets having some nice moves as well. If we have a look at the sectors within the S&P that worked, obviously last week it was really all about Nvidia. Nvidia were the most important company in the world. We were all focused on the expected moves after market, which was 11%. What transpired was obviously far more superior, and that lifted the full space where we're talking Supermicro, AMD, all the chip plays, all the AI names that had a really big influence up until Friday, where we saw things rolling over. But ultimately last week we actually saw the materials sector the best performing within the S&P. Staples, healthcare, financials, really the only 2 sectors which were down last week in the S&P, and this sort of transcended into global markets with communication services and real estate stocks, REIT stocks, as if you like. If we have a look at the internals on the S&P, you can see that there has been good broad participation. I know people are saying there's real concentration in that leadership once again, with Nvidia obviously putting in so many points and the chip stocks putting in so many points. But if we have a look at the amount of companies, the number of companies in the S&P which are pushing above their 20-day moving average, you can see this is currently sitting at 73%. So there is decent participation in the rally that we've been seeing. There's certainly no divergence playing through. We're seeing reasonable participation. Obviously, when we're seeing a market at all-time highs, we'd like to see, more companies above those levels, but they are pushing up a little bit there as well. We can see the number of companies that closed on Friday at 4-week highs sitting at 28%, and the number of companies with an RSI above 70 at 15%. So there has been pretty good participation. It could be better, but it's not really giving me necessarily any red flags that we've been seeing playing through. What we can also see within this is the hedging complex. If you have a look at normalized skew and skew, so we're looking at 25 delta call 25 delta put premium of implied volatility relative to S&P 1 month call volatility. You can see that hedges have been rolled right off. So puts are only trading 1.7 vols richer than what we're seeing in calls. So people have been removing those hedges. That does leave us a little bit downside in terms of being vulnerable. Now, in terms of FX markets, we go through there. We can see that last week, we can see that the Kiwi dollar was the best performing currency in the sort of majors. The Zloty did quite well. But the Kiwi dollar is interesting because we've got a central bank meeting on Wednesday, which we'll talk about in a second. You can see that there was good flows into the Stocky, into the pound, into the euro, On the downside, we saw some of the EM currencies. A bit of a mixed picture across, the major currencies that we see playing through, and that's interesting. Now, in rates, we can talk about that in a second, but we did see a bit of a mixed picture in the US Treasury complex as well. Now, one of the other factors that we need to look at for our trading environment, I think this is really, really important for this week, are the volatility structures and the market's anticipation of movement. Now, obviously, this plays into how much risk we're taking on in a position, but it also plays into the position size that we have. If we have a narrower stop because there's less volatility, less movement in the market, of course, we can then have a bigger position, and vice versa. If we do see a situation where the market is seeing bigger propensity for movement, we typically trade with a wider stop loss, we're taking more risk, and therefore we need to trade with a smaller position size. But if we have a look at what we're seeing here in the top pane, we can see G7 FX volatility. So there's a benchmark by JP Morgan. We can see the implied volatility in the G7, the top 7 currencies effectively, trading at 6.6%. Now that's an annualized standard deviation. It just really goes to show the expected movement. But you can see that across these pairs right now, it's at multi-year lows. The VIX has started rolling back down. Not great. Equity volatility was moving a little bit higher, and it looks like it's rolling over in line with the roll-off of some of those hedges that I talked about a second. If we have a look at gold, which is our most traded product here at Pepperstone, you can have a look at the 1-month implied volatility, the expected movement in options pricing. And again, 9.92%, very, very low levels. And then you can see realised volatility, which actually pushed up a little bit there. But you can see very low levels in sort of expected movement in gold. And we can see in bond volatility as well that the MOVE index, which is an index made by Bank of America Merrill Lynch, you can see has sort of rolled over again. So what we're seeing across asset class at the moment is pretty low volatility. Now, if I have a look at my Excel spreadsheet, which I'm pulling volatility from the options brokers, what we can see here is we're looking before we go into the week ahead. I want to have a look at the expected movement for the week ahead. Now, this takes in volatility and statistical levels of volatility and how that's been, and then it will increase a premium on top of that depending on how market makers and the market sees the event risk for the week ahead going down. Now, for what we can see here is then we can replicate certain option strategies like straddles to understand the expected movement up or down with one standard deviation or 68.2% probability or level of confidence, and 2 standard deviations, which is a 95% level of confidence. What we can do then is we can use the expected movement to define a range that the market's anticipating for the week. Now, if we have a look at this, I've pulled out the volatilities and I've done the calculations, but you can see here in this column here where these volatilities lie relative to the 12-month range, and they're right down into the lowest, near 52-week lows, lowest percentile of the 12-month range. So expected movement for this week is very, very low, and you can see the sort of expected number of pips that the market's expected to trade in up and down. Now, if we take euro dollar for example, we can see that's currently expected to have a move on the week of 65 pips with a near 70% level of confidence, which gives you a sort of a trading range that the market's anticipating of 108.80 to 107.51. Now, if we draw that onto the charts, you can see in euro dollar, this is the anticipated move that the market is saying with a 70% level of confidence. Now, we can see that it's trading sideways, and for me, that makes it very easy to think that perhaps we're looking to do mean reversion strategies on the week, looking to sell into this 108.80, which is where the market saw big supply before, and looking to buy pullbacks into those levels and hope that we're going to see a continued range trade through the week. I think that's probably one of the trades that I'll be looking at for the week. That's what the options market's implying with a 70% level of confidence. That's what we're seeing in the price action. So for me, if we were to get up into 81.80 or down into 71.50, I think there's going to be a good trade there to be looking to trade mean reversion strategies, because we can see the market is moving sideways in that situation. The point here is that we can see that the market is anticipating very low levels of volatility or movement for this week, and that obviously plays into the position size. What it also tells you is it gives you a good understanding of the event risk that we're going for the week ahead and how that may go down, what that means for expected movement. So let's have a look at what's expected for the week ahead. Let's have a look at the landmines that we've got ahead of us. Now, of course, in this situation, let's go to the calendar for the US and see how this sort of plays out into markets before we go to the charts. We've got Core Logic House Price Index, not expecting that to be a market mover. Consumer confidence, that's expected to tick up to 115 on the conference board numbers there. Not expecting that to be a market volatility driver for any asset class, to be fair, unless we got a much higher number. I think that could support equity risk, and certainly on the US 2000, the small cap markets would like that. I'm not expecting the GDP numbers to really to move markets, because they are just a revision of what we've been seeing before. But the highlight of the week then comes out to be the PCE deflator and the core deflator number. Now, this is what the Fed set policy to. We are expecting a big number there, because what we've seen from the CPI basket, it takes elements from the CPI and the PPI and then projects it into the CPI, into the core PCE. But the market here is looking for core to be up 40 basis points month on month, which if you'd done this a year ago, that probably would have been the trigger to raise rates. And that puts you on an annualized rate of 2.8% as well. We've got ISM manufacturing numbers. Now, if you have a look at ISM manufacturing, the market is expecting that to improve slightly. It's still going to be below 50, which of course is the expansion contraction line. Below 50 is another contraction. And this would be the 15th or 16th month in a row that we've seen manufacturing or PMIs there under pressure and contracting. So a reading above 50, I think, would be quite positive. I don't expect it to be a volatility event for the markets, neither is the options market, as we talked about. But what it's saying here is that they are expecting another contraction. So an expansion would be the first in 16 months, and that would reinforce perhaps this US dollar exceptionalism story, and perhaps promote a little bit of selling in the back end of the Treasury curve, and also in buying into the US dollar as well. But not expecting any of these to be a major market driver. Let's have a look at this PCE. I think that's going to be the one that gets the lion's share of attention. Now, if we have a look at central banks, there's a whole raft of federal bank speakers this week, and I think probably the one that's going to get the lion's of attention, maybe John Williams and the New York Fed, but also Christopher Waller. Anyone that has Christopher Waller, he seems to be the man who is the architect of Fed policy, or certainly the canary in the coal mine of guiding markets as well. So you can see him speaking on a paper that discussing monetary forum. Maybe we're not going to learn anything more, but anytime you see Christopher Waller stepping up to the microphone is the time when you're expecting to see that. What else are we watching? Let's have a look at New Zealand. Interesting one here. We've got an RBANZ rates decision on Wednesday. The bulk of economists are calling for rates to be kept on hold. There are two economists, though, if we go into here, who are calling for a 25 basis point hike. What a remarkable turnaround that we've been seeing in Kiwi rates. And this is one of the charts that I want to have a look at as one of the charts of the week, which I'm taking from the bottom. Go back to the 2nd of December, to 2nd of January, the market was implying 121 basis points of cuts into Kiwi rates. We're now sitting at 27. That has been an absolute breathtaking repricing of New Zealand rates. And that has supported the New Zealand dollar. It's one of the reasons why anyone who's a currency trader would have seen that the Kiwi dollar has been outperforming lately, because we were talking about very aggressive rate cuts at the beginning of the year. Now we're only expecting one rate cut by the end of the year, and there's a chance that we may even get a rate hike in the short term. Now, that is a remarkable chain of events that we've been seeing from Kiwi rates in that situation. But the market is therefore saying, yeah, that is something that we do need to watch for. Now, if we go back to this point, you can see the RBANZ. So that's an interesting one. So if we have a look at rates markets, let's have a look at what's being priced in. I'll go to my interest rate charts. Okay, we've got 4 basis points of hikes being priced in for this meeting. We can see from a matrix here, which gives you about a 16% probability of a rate hike. If we were to see a rate hike, if those two economists that are calling it are correct, obviously we're going to see a spike higher in the Kiwi dollar, even though that world has amassed a decent sized position in the Kiwi dollar. But you can see here that the market is implying a small chance of that situation. I think that they leave rates on hold, and it'll be coined a hawkish hold, which should see the Kiwi dollar supported on pullbacks. And that's the way I want to play it this week. I think if we get any weakness coming through in the Kiwi dollar, I think that's a buying opportunity, because I still think that they're going to keep the door open for rate hikes playing forward. Let's have a look at Japan. Interesting one coming through in Japan tomorrow. We've got national CPI numbers. Now, one of the reasons we're seeing a bit of weakness in yen, obviously people have been talking about it being a pure rates trade and central bank divergence. But have a look at the numbers we're seeing tomorrow. The national CPI numbers, ex-food and core, expected to pull back quite sharply. This sort of justifies this dovish stance that the BOJ have maintained for some time. Headline inflation expected to drop 70 basis points to 1.9%. Core expected to drop 40 basis points to 3.3%. that really justifies that situation. If we were to see anything lower than that, then you'd expect to see some yen weakness playing through. We are seeing the first sort of 10 basis point hike being priced into Japan rates by April, and they only work in 10 basis point increments. But that's an interesting one there. If you've got a yen exposure, do keep an eye on that. Nothing really else that really concerns me too much playing through there. Another one to watch out for the week ahead. Let's have a look at Europe. On Friday, we're going to have the first estimate of European CPI. That's going to put us on notice for euro positioning. So we'll talk about that in a second. But you can see that the first estimate of headline expected to come in at 2.5%. The market is expecting core to drop 40 basis points to 2.9%. So again, something that we do need to concern ourselves with. And if we have a look at euro pricing as well, you can see what's being priced. And I pulled this out from Bloomberg. This looks at the implied, or where the market sees rates being at a certain time in the juncture. So we can understand market pricing or expectations around rates. And we can see here for the March meeting, very little is being priced in. But you can see the first full rate cut of 25 basis points being priced in by June. And by the end of the year, we've got about 95 basis points, or 4 cuts if we work in 25 basis point increments by the end of the year. Just going back to that US situation in terms of what's being priced into US rates, we can see that March is obviously a no-go, not going to happen. May, we're pricing about a 1 in 5 chance. You can see 22%. We get the first full rate cut. Well, June's a live meeting, 83% chance. And then July is fully priced. In fact, if we're going into US, we need to understand that in March, on the 8th of March, we're going to have the non-farm payrolls number. On the 12th, we're going to get the CPI number. If both of those are hot, I think this rate pricing dynamically changes, and I think we could see much higher volatility in markets. We'll have to watch that one coming through. But I think that's going to be an interesting one, this European CPI number. We have to see how that one goes down. Not really much to worry about in the UK. In Australia, we're not really pricing any rate hikes until sort of August, September time. The one that you want to look out for is going to be the CPI print, which comes out on Wednesday. This is the monthly print. This is the first one of the month that goes into the quarterly numbers. The market is expecting that to tick up to 3.6% from 3.4%. Now, bear in mind, this is going to have a large sway towards goods rather than services. So there's probably some downside risks. And how much the mark trades on this one, because it only covers a percentage of the basket, is yet to be seen. But of course, everyone's focused so much on CPI that I think this could get a big run going forward. So they're probably the event risks for the week. We've got ECB speakers as well. Let's go to the charts now and have a look at how things are transcending. First one I want to have a look at is what's happening in the S&P 500. We talked about what was happening in the lack of hedges. People have been rolling off those hedges. If we have a look at this, we do seem to be sort of topping out a little bit. There does seem to be a bit of a selling pressure playing through. I'm just going to take the ranges off here. One thing I want to look at now is the divergence that seems to be taking place in the market. All right. Okay, so we are seeing divergence that's taking place between higher prices and the RSIs, which are falling away. So that may play out. It may show a topping situation. We're seeing okay participation. We're seeing divergence, which needs to play out. We're seeing falling ranges, something to be watching playing through. Now, I think if we're having a look at this, and we are seeing still very low volatility, a lot of what we've been seeing here is driven by options pricing and dealers having to hedge their exposures. But I think if we look at this on a weekly chart, the level you want to watch out for around these kind of lows here, around sort of 49.18, which was these lows. I think if we get a break below these levels, I think you're going to see higher volatility. I think the market starts to de-risk. Volatility generally begets higher volatility. So these are the lows. As long as it's staying above the 5-week and 5-day exponential moving average, I'm staying relatively constructive on these equity markets. There's no real reasons right now to be selling or shorting these markets. If you're looking at the higher time frames, obviously if you're working lower time frames, there's obviously opportunities there to work on a day trading basis. But on the higher time frames, if you swing trade it or you're taking those sort of swing time frames, it really suggests that you're either neutral or long in this situation at the moment. But I think if we break below those 49.18 levels, below these lows, and we can close below those, I think there's going to be opportunities for short sellers on the higher time frames as well. If we have a look at the weekly chart of the Russell, we're getting right into the top end of that range again. This is an interesting one. No real reason to be shorting this market at the moment. We do have some divergence playing through once again. But I think, for me, I'm staying out of this until we get a close above this on a weekly basis, and then I'll be looking to try and re-establish long positions for a further move higher in that situation. But we're right into the trend. I know there's going to be people out there looking to sell into these levels at the moment. Staying where the strength has been, we've seen really strong moves in Japan. If we have a look at that on a daily chart, we can see that right now it does seem to be topping out a little bit, but we're still holding those short-term moving averages. So I'm staying constructive until we can get a close below those levels and then back below 3,800. If we get back below 38,000, I'll be looking at shorting opportunities. But for now, this market still seems to be a buy on pullbacks, and the trend remains your friend as long as we're seeing price close above that. Europe as well, similar story. Where we like as well, we've seen really good buying has been in the Chinese markets. Let's have a look at the Hang Seng. Really nice melt up playing through. I think I like this one higher, continue to see that. We've got the Chinese manufacturing numbers on Friday, which could be quite interesting to see. I was seeing a bit the CN50 rollover. That could be an interesting short. And also in China, in the China H on the Hong Kong side, markets holding up. But the mainland market's rolling over a little bit today. We'll have to see how that holds up. In FX markets, we want to have a look at euro dollar. We just talked about that in a second ago, where we're seeing the move sort of moving sideways. I like this one sideways. We can see now a couple of inside days playing through. But I think trading this sort of Bollinger Band, this sideways trend seems to be the probably high probability trade for this week. So looking to continue trading this sideways move. And you can see that again in the dollar index, which is just sort of moving sideways, doing a reverse opposite effectively of what we've been seeing. Dollar yen, we're trading this sort of pennant pattern, this triangle pattern here. I'll be waiting for a breakout top side of this to re-establish long positions. We'll have to see how some of that US dollar data transforms and what happens with bond yields. But I think if we get a break of this, and obviously the Japan numbers that come out tomorrow, if we get a break of this, then I'll be looking to re-establish longs for a rear-test of those November highs that have been playing through. We are seeing very, very low volatility playing through. Have a look at Kiwi dollar. We are seeing a bit of position unwind after a big move last week, which we talked about. People are looking to de-risk those Kiwi longs going into the central bank meeting that happens on Wednesday. So maybe a bit more downside, perhaps maybe falling down to the 20-day moving average. What you can see, Kiwi yen's been a big performer. A little bit downside here, but then I'd look to trim back for probably a nice dip and buying that dip going post the RBANZ meeting. I think they will be hawkish. The market is just de-risking after a very, very strong move up here. And that will be the same in Aussie Kiwi, which has fallen recently, and Aussie Kiwi's come back. So I like Aussie Kiwi to the upside in the short term. And you can see a nice reversal playing through. We've re-established back above the 5-day exponential moving average. I think this probably trades a little bit higher in the short term into the RBANZ meeting as some of that positioning comes out of that very well loved short position playing through. So interesting moves playing through. That's kind of where we're sitting. Dollar Swiss is again trading sideways. I think when we go to the Swiss National Bank meeting in March, I think there'd be a good opportunity there to sell Swiss going into that situation. Let's have a quick look at commodity markets. Yeah, crude's got a really interesting setup here. You can see this sort of neckline, if you will, of the inverted head and shoulders pattern. We're in a bull channel that's just meandering around. But yeah, I think if we get a break of this level here, 78, 74, then that would be a very big positive for the crude market, probably negative for other markets as well. But that's the level I'm looking at as well. I think if we can get a close above that level, I think we can push back into sort of 85, 90. What level does this become a problem for inflation and global markets? They start saying this needs to wear a higher risk premium, probably back into 95, maybe $100. I think the market starts de-risking if we were to see that situation, especially if we go into the February US CPI numbers and we expect that to be hot. That could see equity markets wearing a much higher volatility. But we're just holding that level at the moment, and we're just watching to see what happens. Perhaps we trade a little bit down back into the bottom of the channel, down to 74.23. That would probably be my preference. But if we were to see a close back above here, then I'll be flipping long and looking to go to the trade this one to the upside. On gold as well, which is obviously our most traded product here at Pepperstone, we are seeing markets were looking like to roll over into 1980, but we've just gravitated back in. It is a grind. Price action is a grind. It's a very frustrating trade where we want that impulsive range expansion. It's not happening at the moment, but we're back into what was the formal middle of the range at the moment. I think you trade the Bollinger Bands in a sideways move, so I'm looking to fade moves into 2054, looking to buy back into 1994. I think that's probably the trade for the week at the moment. That's sort of implied with what we've been seeing in volatility as well. So that's the setups. I mean, if you can go into some of the setups that we're seeing in some of the agricultural markets as well, really strong. Anyone who likes trend following, would be all over these moves at the moment. Corn, sugar, I like this one. Lower, I think this one continues to trade. This is an early move, but I think this one trades lower. So I think I like this one from the short side with stops above $23. Wheat, nothing really going on there, but you can see, bear trend in soy meal. What's happening in lumber? That's okay. Soybeans is down. Cocoa's had a big move to the upside recently. I like this one higher, further higher from here, buying pullbacks. Let's have a look at cotton. Yeah, so there's some really interesting moves that are happening in the softs and the ags. Yeah, you find you pay a bigger spread for that, but you get that propensity for movement, that trending dynamic that trend followers and momentum traders love. Let's have a look at coffee. Yeah, I think this one trades lower. I like this one short with a stop above 192.25. I think this one's got momentum that's building. So I think that's going to be some interesting opportunities that are taking place in the agricultural commodities at the moment. So there's setups we're looking for the week ahead. One chart that I want to just quickly have a look at is what's happening in economic data surprises. People talk about the exceptionalism story in the US. We'll have a look at the Citigroup Economic Surprise Index, which looks at the actual data coming in relative to expectations, and you can see that has been beating consistently. You can look at that relative to some of these other markets where in the UK data's been coming in okay. China's been slightly beating, and you can see that in the Europe data has been coming in slightly better than expected as well. But you can see when we talk about this US exceptionalism story and why we've seen some pockets of strength in the US has been because the data has been continuously beating expectations. I think we'll leave it at that point. It's been interesting situations for the week ahead. I think that gives us we've seen very low volatility in the market, low ranges. It generally means we're going to see a chance to keep those position sizings a little bit bigger, take on a little bit less risk in the market. But we are seeing some numbers that suggest that we could see, if we were to trigger some high volatility in the market. For now, looking to range trade some of the euro pairs, the dollar pairs. We're looking at levels in equity markets where volatility could pick up. We're still taking a fairly constructive view on what's been happening there. Gold trading a range. We're seeing crude levels where we could see breakouts, and some of the agricultural commodities having some really good runs as well. We'll see you next week.